All right, let's get right into it. We're going to break down a really powerful tax strategy, one that a lot of people assume is just for the super rich. I mean, how can someone with a six-figure salary end up with a $0 income tax bill and do it completely legally? It sounds impossible, doesn't it? Well, it's not. We're going to deconstruct the exact mechanics behind this, using rules that are literally written right into the tax code.
Okay, first things first. To get a tax bill down to zero, you obviously need a huge deduction. The key here is a concept called a paper loss. It's basically a massive non-cash tax deduction that we need to create.
So, what exactly is depreciation? Well, the really interesting part is why it exists. See, the government wants people like you and me to provide housing, so they offer this big incentive. They let you deduct the wear and tear on your rental property's structure over time. Even if your property is going up in value, you get to claim this loss on paper. It's a powerful tool. But here's the thing. Waiting almost 30 years to get the full deduction, that's way too slow. I mean, it's fine, but savvy investors know that a tax deduction today is way more valuable than one 20 years from now. So naturally, they figured out a way to hit the accelerator. And this is how they do it. It's called a cost segregation study. Think of it like this. An engineering team comes in and dissects the property. The building itself, the structure, that still gets depreciated slowly. But all the other stuff, carpets, the kitchen appliances, the light fixtures, all of that can be written off way, way faster. You're basically pulling decades of future tax deductions into the first few years of owning the property. And look at the difference here. It's huge. A standard deduction on a $500,000 building might get you around 18 grand. That's okay. But with an accelerated deduction, you could be looking at over $120,000 in year one. That is an absolute game changer. That is the massive paper loss we need. It's the engine for this whole strategy. All right, so we've got this giant paper loss. We're all set, right? Well, not so fast. There's a major roadblock. A really critical rule that stops most regular W-2 employees from using these kinds of losses against their salary. It's called the passive activity loss rule. Basically, the tax code puts up this big, thick wall. On one side, you've got your active income, your main job, your W-2 salary. On the other side, you've got passive income and losses, like from a typical rental property. Our huge paper loss, it's stuck on the passive side, and we can't use it. So you can probably see where this is going. The entire strategy comes down to one thing. We have to find a way to legally reclassify that loss. We need to move it from the passive bucket to the active bucket. We have to find a secret door in that wall. And guess what? There is one. It's called the short-term rental exception. The tax code itself carves out a special rule for a certain kind of rental. This is the key that unlocks everything. So how do you qualify? It comes down to two simple things. First, the average gas stay has to be 7 days or less. So think Airbnb, that kind of thing. Second, you, the owner, have to materially participate in the business. If you check those two boxes, bam, that huge paper loss is no longer passive. It becomes an active loss that you can use to directly wipe out your W-2 income. Okay, so we've got all the pieces of the puzzle. Let's put them together and look at a real-world case study with actual numbers to see how this plays out. We're going to walk through this in 4 simple steps: the person, the investment, the paper loss, and the final result. So step 1, let's meet our taxpayer. We've got a professional making a good living, $100,000 a year. Normally, they'd be writing a check to the government for about 15 grand in federal taxes. Step 2 is the investment. They go out and buy a property specifically to use as a short-term rental. The building itself is worth $500,000. And remember, because it's a short-term rental, it qualifies for that special exception we just talked about. All right, step 3. They put the plan into motion. They get that cost segregation study done, which, as we saw, supercharges their depreciation. The result? a whopping $120,000 paper loss, all in year one.
And now, for the magic. Step 4, the final result. You take their $100,000 salary and you subtract that $120,000 active loss. What's left? Their taxable income is now zero. Actually, it's less than zero, but for tax purposes, it's zero. And what does a $0 taxable income mean? It means a $0 tax bill. That's it. By combining these two tools, accelerated depreciation and the short-term rental rule, their entire federal tax liability for the year just vanishes. Legally. Okay, that's amazing for year one. But you're probably thinking, what happens down the road, right? What happens when you eventually sell this property after taking all these deductions? That's a great question. And of course, the government has a plan for that. You can't just get all these tax breaks and then walk away completely free when you sell. There's a process to account for it. So here are the two big concepts to know. The first is depreciation recapture. When you sell, the government basically says, hey, remember all those deductions we gave you? We're gonna tax that now. But, and this is a huge but, there's another tool called the 1031 exchange. This lets you take all the money from the sale and roll it over into a new investment property without paying those taxes yet. You basically just kick the can down the road and keep the cycle going.
So, when you step back and look at all this, what does it really mean? It shows that this isn't some shady loophole. It's a set of incentives put there on purpose by the government. And it really drives home the point that building wealth isn't just about your salary. It's about understanding the rulebook and how to use the incentives the government gives you to your advantage.